Monica, let's also pivot to the big macro story stateside and how this could ultimately impact our region. Of course, a big focus has been on this non-farm payrolls print through the course of this week. We've just seen the headline number beating the street. Wall Street moved higher, interestingly, off the back. Do you think this is going to be enough to challenge President Trump's rate cut narrative and this push for the US Federal Reserve to start moving?
Absolutely, and what this print does is gives the Fed more time for its wait-and-see approach. So far, we've seen the labour market remaining strong. This was highlighted by the FOMC at the last meeting. Unemployment has come down. There's very little impact so far of the tariff uncertainties, either on inflation or the labour market. FOMC Chair Fed Powell has said that it's really from the June to August period that he expects to see more of an impact of the tariffs on inflation. And with the labour market so healthy, this gives them time to stand on the sidelines over the summer period. And I think it's also important that there's a lot of moving parts on immigration, on labour market supply, but also now fiscal support to the economy as well.
So, Monica, bond yields moved on this, but why wasn't this more hawkish for markets? Wall Street was happy to rally through the prospects of higher for longer rates, it seems.
Yeah, I think you did have some unwinding of expectations of rate cuts. So ahead of the meeting, the market was pricing in 75 basis points of rate cuts. The July meeting, which is at the end of the month, was seen as live, and now that has shifted. But I think one of the key areas of that the market was focusing on was the US dollar. Some of the weakness that we saw ahead of the week, the print, did indicate that more rate cuts might be on the cards. And we've seen the US dollar tick up on that front. But also the bill, that's also significant because this is showing a loosening of fiscal policy. This is showing the expectations that debt will continue to increase. And going forward, what you might see is the 10-year yields ticking up again as this fiscal loosening happens and supply is going to remain strong, and higher interest rates might be needed on the treasuries to keep demand up from external purchasers. So we've got two moving parts on this area.
Indeed, and that's going to be so interesting to watch as we try and assess the mid to long-term implications of the passage of this big bill, the mega bill stateside. Monica, do you see any implications for us here in the region?
Absolutely, and of course it's monetary policy and it's the currency. So on monetary policy side, the markets are now expecting 2 rate cuts more towards the back end of the year. We've seen the GCC economies with strong momentum being able to absorb the still relatively higher interest rates. But as we've discussed before, inflation is lower. And I think as the Gulf economies progress with their investment programs, rate cuts will be positive. On the other hand, we've seen the dollar weakening, and therefore our currencies have weakened as well. It's not stoking inflation so far, but it is supporting competitiveness of the non-oil economy. We're seeing positive momentum in areas such as transportation, hospitality, tourism, and this is positive for that. But we think much of the dollar weakness has happened in the first half of the year, and we see less movement in the second half.
Okay, so that's interesting because, of course, what you're talking about here is regional monetary policy alignment with the Fed because of the regional currency peg. It means these local central banks have to move in lockstep with what the US Federal Reserve does. At the same time, Monica, interesting point on the USD as well, because you could also draw the assumption that a weaker USD and perhaps a USD that continues to trend weaker in H2, as some have suggested, is also good news for our part of the world. It's good for tourism, it's good for exports, and so on. Do you see dollar weakening further as a result, and what is the translation for the region?
Absolutely. We do see some further weakening in the US dollar, but not to the same magnitude of the first half of the year, where you saw about a 10% weakening of the US dollar index from its 13th January high. We are seeing that being supportive, especially in the second half of the year. The economic fallout from the tariff wars, from immigration policies, expected to be more felt, and also we've seen first half of the year benefiting from a front loading of spending and a front load of global trade as well. So I think at a time when global growth slows further in the second half of the year, a weaker dollar is very positive for the competitiveness of the non-oil sectors, the externally facing sectors. It helps with their competitiveness, and this means that as global demand weakens, that the manufacturers, the companies here, corporates, including on the service side, will have to price discount less to continue to support demand. So the competitiveness boost is a positive for the UAE and the wider region.
Monica, of course, the next focus for markets at a macro level is going to be what's happening with trade and tariffs as we come into this July 9 deadline stateside. What is the impact for us here in the region? And do you see the Gulf economies perhaps being more insulated or more vulnerable to the trade and tariff agenda that we're seeing come out of the Trump administration?
I think certainly we're less exposed directly as a result of that. The GCC economies have trading deficits with the US. Most of the exports are very limited as a share of overall exports to the US, and it's mostly in areas like aluminium, metals, steel, and so on. So we think the direct impact is going to be very muted, but it's more the indirect routes. So, of course, if you see global growth slow down, weaker trade, then the demand for oil, that's going to be a main conduit into the region. We've seen oil prices again moderate below the $70 a barrel level. So that's something that's going to be a key driver of economic developments in the region. This is also at a time that OPEC Plus is increasing supply, and we do think that the oil prices will be softer in the second half of the year than in the first half of the year. So I think it's really going to be the indirect channels through weaker growth, weaker oil demand, rather than the direct trade impact. But of course, you know, we are an important transshipment hub from east to west trade, and if you do see this trade coming down, which we expect anyway because of the front loading, that'll also impact some key non-oil sectors.
Indeed, one of the key risks for this part of the world, and I think you characterized it well, is the fact that if we saw a ramp up of tariffs in the United States, particularly towards large economies like China, that could have a direct impact on external demand, and in particular demand for oil from this part of the world as well. Monica, you mentioned you expect oil prices to fall lower. I wanted to pick up on that point because we're also coming into this really important OPEC Plus meeting on Sunday. So far, the market talk and the expectation is that we'll see an additional 411,000 barrels coming online, with OPEC sticking to its plan to continue to add more oil to what is, some would say, a pretty well-supplied market. How much lower do you think oil prices go in H2?
Well, we are assuming oil prices average between $60 and $65 a barrel in the second half of the year. I think one reason why the oil prices have remained stronger above $65 is a lot of the supply increase that we've seen from the GCC economies are being kept in the region. There's more demand for cooling in the seasonally warmer period of the year. Also, we've got in the US, we're entering the peak summer driving period. It's really after the summer period that we think that inventories will build and we see stocks increasing. So that's why we do see a weaker oil price in the second half of the year than the first. our view is also that OPEC Plus will increase output again by about 411,000 barrels a day in the meeting next week.